Hello, and I'd like to welcome you to the next conversation piece. Today we've got Colin Williams from HFS Consulting. So he's going to talk to us about a range of matters that are impacting upon our industry, primarily that of financial advisors and people that are coming and going and everything that's taking part at the moment. G'day, Colin. How are you?
I'm great, Rob. How are you? And hello to everyone watching in. And thanks for having me on board. It's great to be part of this. And yeah, there's a lot to get through. It's been a crazy time, I think, this last couple of years or so. And of course, now we're right into COVID as well. So just when you think it couldn't get any more difficult, it does. So, but anyway, some positives as well that we can talk to.
Yeah, sure. So I guess from a practitioner perspective, we've all been aware of what's been going on in the regulatory environment over the last couple of years. What has that meant for numbers of financial advisors?
Well, I've got plenty of numbers, Rob. and what I would say is that on my website, hfsconsulting.com, do a quick search for me or that. You'll find a lot of the data I'm quoting will be on the website. There's a series of dashboards, if you like, that you can go through on there. Some of the numbers I will be talking about is not quite released yet. I do a large quarterly update, and that's not quite finalised, but I will quote some of the numbers today. But I'll just quote some numbers, and feel free to stop me if I'm just rattling these numbers off, but there's a lot of stuff there, and I think it kind of lines up with what happened over the last couple of years, particularly the Royal Commission, and then we'll talk about how FASEA might impact that as well. So just to quote where we're up to today, as in the latest data to basically June 30th. This year we've seen some 2,000 advisors drop out, as in advisor roles drop out since the start of the year, which is pretty significant because during the course of 2019, we saw 4,300 roles drop out. So in total, since January 1, 2019 to now, we're over 6,000 roles down, which is huge. What's driving that? I know there's been a lot of discussion about different things, but if you think about since 2019, we had the Royal Commission in 2018. But what we've seen predominantly are the banks, the big four banks, either get out of financial planning or reduce its holdings in financial planning quite significantly. And that's been driving it. And I think a lot of this was going to happen with or without the Royal Commission. ANZ sold a large part of its business prior to the Royal Commission coming up. You may recall to IWF. And then as the Royal Commission rolled through, the other banks started making announcements about the fact that they're going to reduce their numbers. So to put that into some sort of perspective, if you go back a couple of years to 2018, at the end of 2018, the banks had over 2,000 advisors on its books, as in salaried advisors. I'm not talking about the dealer groups, I'm talking about the salaried advisors. We're now down to 754. So it's about a third. It's a huge hit, if you like, in terms of advisors. Some people would say, well, that's being picked up by the super funds. Well, actually, that's not happened at all. The super funds have been pretty consistent at around 1,000 advisors, even though the super funds have seen significant growth in assets over the last couple of years or so, and accounts and so on, but not in terms of advisors. And of course, recently we've just heard that Q Invest or Q Super combined are reducing their advisors, and we've seen a merger between State Super and Big Super, and I'm guessing there might be a few losses there as well. So they've been hitting the losses, and a lot of those losses, I think, particularly the banks, were driven by the fact that they can't make a dollar or enough dollars to satisfy their shareholders. Thereafter, we've seen a reduction in the self-employed sector. That's come off quite a bit, and we've seen and when I say self-employed, I'm talking the traditional dealer groups, of which you're one of them, and AMP groups, Hill Ross, MLC groups, and so on and so forth. They've all taken big hits, but those big hits have been predominantly in the corporate side. When it comes to the smaller groups, we've seen the smaller ones with less than 20 advisors, or what we often refer to as self-licensed. They've kind of ticked along, but nothing dramatic either. So what I'm going to do now, I'm just going to quote a few figures just to sort of send this message home. And as I said, it's a bit bleak early on, but we'll get onto some more positive stuff as well. If we look at the losses since July 1, 2018, so it's just, if you like, at the height of the Royal Commission as it kicked off. But since then to now, we've had Westpac Banking Corp get rid of all its salary advisors, so it's 476 advisors down. AMP down 418 advisors. Commonwealth Financial Planning, again, these are salary advisors, and they've still got a team, but they're down 400 advisors. Dover, remember Dover? Some people do. They're down by 392 advisors, Financial Wisdom 334, Securities 295. These are big numbers. It doesn't matter how you look at it. They're big, big numbers. And if you look at the upshot, which groups have actually made some inroads to that over the same period, yes, there are some groups which have made positive numbers, and Shartru is one of them, but the numbers aren't anywhere near as high as the losses. So, for example, Fortnum is the only group with 100 plus during that period. We've got Viridian, Lifespan, Capstone, you guys are there, Synchro and Interprac and so on have gained advisors, but we haven't made up for those big losses, and that's what's been driving it. I know a lot of people are curious as to where all this goes in terms of maybe where the trends are here on in. And I think part of that trend, and I'm just sort of pull these numbers up again, part of that trend is what's happened to the self-licensed area. I mentioned the number of advisors in licensees of less than 20. They've been relatively steady, hovering around 6,000 advisors. But if we narrow that down to the self-licensed, as in the 1 and 2 advisor models, it's probably not what people expected. So this is from Jan 1, 2019, so 2020, sorry. So from the start of this particular year, we've had 42 new licensees commence of 1 and 2 advisors. So 14 were two advisor models, and 28 were single advisor models. If you like, 56 in total, representing those 42 licensees. Meanwhile, we've had 112 licensees close its doors during that time as well. So it's almost like getting close towards a 3-to-1. So for every one small one person, 2-person advisor licensee open, we've had close to 3 closing, which is quite significant. So if we go back to Jan 1, 2019, we've had 246 of those small licensees closed, but only 107 commenced. So it's roughly 2.5 to 1. So every one opening, 2.5 are closing in that area since the start of January 2019. So that is significant. So it's a trend that's probably going in the opposite direction that people thought. What we're kind of seeing in that is that a lot of people thought, this is a great idea, I'll run off and I'll start off my own license. And this may have been done well before the Royal Commission and so on, but it's just too hard. It's very, very hard to run your own license. So a lot of accountants, I guess, may have started them off and thinking, oh, well, this is convenient. I'll be an accountant and a part-time advisor. Just being a part-time advisor hasn't been a good idea, a good option, given all the changes. So I think that's been quite significant. And
I must admit, Colin, I'm a bit surprised by that. I was one that thought that self-licensing, if you will, was really getting a foothold the last couple of years.
Well, there's been a lot of talk, I think, and it certainly has had a foothold. There are certainly new businesses opening up in that area, but there's a lot closing down as well. And I think what tends to happen, you and I both been in financial planning world for a long time, when you dig into the numbers, there are a lot of people who aren't, I guess, the sort of advisors we would come across, but are on the register in some way. So these are part-time accountants, or maybe they've set something up alongside with a mortgage broker or part of a finance company, or even some funds management. I think it's a good idea to have a few advisors on hand, and just running that type of part-time model or part-time advisor model hasn't worked. And even I think for the full-time models, they're finding it's just too hard. I know I had a major dealer group come to me a while ago, and they were pretty keen to go after these smaller licensees because they felt that they're going to run into trouble sooner or later. They're just not going to be able to keep on going, and they need the support structure of a bigger model to keep that ticking along. So I think certainly as trends are concerned, there's not going to be as many self-license as we may have first thought. And I think that the mid-tiers, which I think Shartru, would fit into a mid-tier type group, will keep doing well. And certainly the instos, I'm not quite sure what an insto is anymore, but they used to be the big 4 banks, AMP and out of all that. I'm not quite sure what's happening to them, because if you look at the numbers, they're just falling away. They're just falling away, and it's difficult to see them coming up with an offer just now that's going to be very attractive compared to a mid-tier, which can be a bit more specialist, a bit more hands-on in helping advisors, particularly at the moment, helping them get through COVID and so on. Yeah,
sure. Okay. No, well, that's all very interesting. And then I guess we haven't even started talking about FASEA yet, and what impact's that going to have. So
well, FASEA is
We've just had the, well, eventually the powers to be got around to granting the extension. So that's pushed the need to pass the exam out another year, and now we've got 2026 as the final date for education qualifications to be met. So what's your take on that? What sort of impact is this going to have?
Look, I think the impact's going to be both short-term, relatively short-term, and then longer-term. At the moment, based on the data coming out of FASEA, we can see a pass rate hovering around 86%. However, in the last batch of exams, that dropped to 82%, but overall, it's running about 86%. Let's assume we get to the end of the year and it's 85% pass rate. That means 15% of advisors are going to drop out, or if you like 3,000 advisors, which is significant. And they've only got a year extension for that. So maybe more and more will pass. Maybe those who have failed will have another go and get through. So it might not be that high, but at the end of the day, it's still, I think, quite significant, and it's going to be a bit of a burden, I think, on a lot of financial planning businesses. Longer term, as we go on to the 2026, is that I do see a bigger issue when you have to get them all formal qualifications. I think it's one thing to get through the ethics and so on, but to get that formal qualification that meets the FASEA requirements is going to be a bit harder. And based on the data that I've got, if you look through the current particular self-employed sector, it's approximately 50% of those advisors have a degree of some description. So now they've got to get some sort of bridging course in, I guess, to get over the line. So that means 50% aren't even close to that. And that's a big number. And again, I did an override of data on that. And that 50% are, in fact, the more experienced advisors, or if you like, the older advisors. And I think they're just going to find it maybe a bit too hard. And probably maybe at a time they can't get motivated to do all that work. When maybe their lifetime in the advice area is probably not that great anyway. So I think that could be.
So would you expect, and I guess just intuitively, I always thought that guys will get through the FASEA exam, and then they'll look to basically set their retirement date to around about the 2026, and then look to leave. But that point you raised about, even if there is a 15% fail rate, that translates to a big number.
It's a big number, yeah.
Yeah, and that's just mind-boggling. It's not something that I thought of.
No, it is scary, and 3,000 dropping out is a lot. It's a big number, and that creates a big hole. And then you're preparing for the next wave of exits, which is further down the track, as you mentioned. So, look, I could put more of a positive angle on it, if you like. I think that what most licensees should be doing now, if not already started, but certainly working their way through, is working with these advisors, particularly the ones who are owning their own practices and or have a big interest in a book or something like that, to work with them to say, okay, well, are you going to get through the current exam requirements, and then B, get the full degree as required, and work with them on some sort of succession plan. I think just waiting for the inevitable to happen is no plan at all, because it's going to be a disaster. So I think working with them, and it may well be, particularly for some practices, is you bringing in new advisors and create a succession plan of some description, and I think that can be done. I also think.
Well, talking about new advisors, how many new advisors are joining the industry? And one of the other side effects of FASEA is that basically all new entrants need to have the degree, but then they also need to undertake a professional year. I'm not quite sure of the ins and outs and the workings of the professional year, but I would suggest that most financial planners are busy looking after themselves at this juncture and trying to sort themselves out. How many people are actually joining the industry? Well,
it's bleak because if you look at the conveyor belt, if you like, we've got a lot of the advisors coming off one end of the conveyor belt and very, very few coming on. So, however, there was a burst in 2018. It was in everyone's interest, I guess, if you're going to get into financial planning, to get onto the register before the end of 2018. So there was a huge growth in that last quarter. But since that quarter, we've had 11 actual advisors, I should say, come on board as an advisor since 1st of January 2019, so
Wow.
18 months. But we have had another 16, and this 16 have come on more recently, pretty much all in 2020, on that professional year. They're actually referred to on the register.
Yep.
Advisor. So that gives you some hope that there are some new blood coming through. I think if I was running my practice and I wasn't going to be around post 2026, I would be looking at maybe bringing someone like that on. And very often it could be family, it could be one of the kids in the family want to come through and take it over. Or B, you might look at, okay, well, who's out there at the moment? I mentioned all these bank advisors who are probably looking for a role. But many of them are very well qualified. They've had some experience, and maybe they just need a bit of coaching to come into the business and some opportunity to maybe take over that book. And it could be all be the licensees might look at them and trying to marry them up, if you like, with a potential advisor who's not going to be part of the game anymore. So there, I think, are the opportunities. So yes, get some new blood, but there is a lot of people looking for a role out there as well. I would imagine, knocking on doors and trying to find an opportunity.
Well, just the arithmetic behind that does suggest that there is going to be a supply crunch.
It's going to be a supply crunch, there's no doubt about it, and I think that's going to create both opportunities and problems. I think if you do the simple maths, if there's less advisors, there's still a lot of people needing advice. Then you do the equation, there's probably more opportunities than less for those who hang around. But if you are dropping out, then you're going to be maybe trying to sell your book or sell your business at a time which is going to be quite difficult, to say the least. And that, and again, looking on a more positive side, you may well find a number of investors, private investors who may not necessarily be from a financial planning background, but might be from a finance background, and understand that a good financial planning practice does generate some good cash flow. And you may well work with a licensee and identify 2 or 3 practices and really merge together. The senior advisors, if you like, are going to drop out. You may keep them on board in some sort of advisory position, consultancy type position, and then blood in some new advisors, take over the book and run it as a business, more of a corporate style business, and offer some opportunities for those advisors to get some equity into that business as well. So we've seen investors come into the market. We've seen that through Paul Barrett's team and a number of others who have come in, and I wouldn't be surprised if that occurs as well.
Yeah, well, on the ground, I'm actually getting approached by a number of people, even from offshore. The issue they've got is the people that they thought that they were going to bring into the business to basically be the advisors. Well, they don't meet FASEA requirements.
Yes, so that's the challenge. Yeah, correct.
Yeah,
it's a massive challenge.
Yeah, it's going to be interesting to see sort of where that all ends up, and whether there is going to be any more tweaking. But as it stands at the moment, it is quite onerous. And I'm talking to guys that are in their 40s. They're offshore. They want to come to Australia. They're good operators, but are they going to literally do what's required to tick that FASEA box?
I think they're coming from overseas and having to effectively start again in terms of getting the education. That could be a real tough challenge. But as I said, there could be some investors who might not necessarily want to come in and be an advisor. They just like the idea of being an owner or a part owner in a practice that can generate good cash flow, and then seek an advisor who may already be well down the track or close to, or even got the required qualifications to start running that business, and you do it jointly, or of a corporate.
Yeah, so I mean, so whilst advisors have got a lot on at the moment, we've got a lot of regulatory change. We've got now we're dealing with COVID, and government lockdowns, and there is a lot on the. I guess there is, if you can get through the next little short period, whether that's 1 to 3 years or whatever it is. The dynamic's definitely going to swing in favour of those that are able to get in and do the job.
I have no doubt, because there will be more losses, and I think, but the requirement for advice, I think, is only going to grow, and the opportunities to get some good clients in and build a good, and if not better, business in the future is going to increase. I guess those opportunities are going to increase, so that makes it dare I say the word, easier to build a better business if they've got less competition around to work with. So
Yeah, no, absolutely. And whilst we've had a lot of regulatory change, and I think it'd be fair summation to sort of say that everyone is suffering from regulatory change fatigue at the moment. I know that I am.
Yeah.
There was a recent suggestion put forward by the FPA that individual licensing should be looked at. Do you have any thoughts on that and whether it's actually practically possible?
Well, I think I did pick up on it when it was released, I think on June the 3rd, and I read through it and read through it again just recently. And look, as I understand it, trying to have a disciplinary setup which would be separate from the normal AFSL. So the AFSL would exist for products, but this new group would be set up to manage the advisors. To be honest, I thought it was a bit short on detail because currently AFSLs like your own do everything that they were suggesting that this one group would do. And I think if you look at what the current licensees do now, there's a lot of work, and I think we've got a long way to go before we can have something else set up. So, for example, if you think of what you do to make sure the advisor is doing the right thing, you've got to make sure the advisor got the qualifications. You've got to do audits. You've got to assist with client complaints. You've got to do the ongoing training requirements. You've got to get involved with the marketing to make sure the marketing is correct, not breaking any rules. Not so long ago, we did see a lot of self-licensed advisors having to put up a warning on their website saying, "Whoops, sorry, I made a mistake, calling myself independent when I wasn't," and all this type of stuff. And that's a lot of work that needs to be done in protecting the advisor. So I think there's a long way to go before the advisors can just have one particular body, if you like, that they report to in that particular body, then says, "Oh, it's got the qualification, tick a box, go off and give advice." It's not, I don't think it's that simple. No. There's a lot of work required to monitor that.
Yeah, no, I think a lot of these ideas come from people that aren't necessarily au fait with what actually happens on the front line, unfortunately. I do understand that. I think one of the concerns is that a lot of people perceive that advisors aren't accountable under the current structure, but that's just not true. There's referenced in the Corporations Act that the advisor can be personally, civilly and criminally liable. So there is accountability for the individual advisor, but yeah, I agree with you. There's a lot of practicalities, and the reality was the industry per se, when a fair chunk of advisors were under the institutions, they couldn't get supervised correctly then. I don't think ASIC would want to necessarily be running around looking after 20,000 individuals, I wouldn't have thought.
That would be a hell of a job. The one thing I would say, Rob, and I was thinking about this when I was reading the FPA information and working it through, I think at the moment there is a big problem in the marketplace, and we've talked about self-licensed and particularly the 1 or 2, 3, 4 man type advisory businesses. And I think there is a need for a halfway house for them somehow, because I think they're working in this huge area of conflict, if you like, because if you're running your own license, you are effectively the CEO, the responsible manager, and the financial planner, and you do your own compliance to some degree. And so, in other words, if you do find something wrong, then you have to dob yourself in. And I don't know how that's not a huge conflict. And at the risk of bringing something up a bit silly here, one of my favourite bands, if not the favourite band, was a band called Motorhead. You may or may not have heard of Motorhead, but they were famous for being probably the loudest band. And more importantly, the guy who started Motorhead was a guy called Lemmy. And Lemmy was just a crazy freak, took every drug known to mankind, drank, and basically kept getting thrown out of bands. So he came up with this great idea. The only way to stop getting thrown out of bands is to start my own band.
He's a problem solver.
The problem solved. So Lemmy set up his own band. He was the lead singer, wrote the music, organised the band, all that type of stuff. And I just hope there aren't too many Lemmys out in the marketplace, if you know what I mean, the financial advice, where you think, oh, my ideas about financial planning are a bit out there. These good dealer groups or licensees, if you like, won't like that. So I'll solve that problem by doing it myself. And I think at the moment that is possible. I wouldn't recommend it to anyone to go off and do something silly on your own. You can still get fined and thrown in jail. But at the end of the day, I think the temptation to do that's there. And one thing we did see in the Royal Commission, and where one individual couple other lights, because for many things, but one of them was on his FSG. He had a degree on there which he never had, and I think that was kind of silly. Whereas I think if it was running in a large licensee, the licensee would have said, well, you can't put the fact that you've got a degree on until I see that degree, if you know what I mean. That's a very simple thing, but it's a ways and means of someone double checking to make sure you're doing the right thing. So
well, I actually agree, and my little crystal ball tells me that there will be a whole range of issues that will come up in the self-licensing space for that very reason. And one of the drivers of that is obviously rightfully so. Hayne and others were very critical of licensees in regards to predominantly the institutional ones in regards to some of their actions, but also in regards to ignoring what had happened in the past and reference checking and yada, yada, yada. So what happens as a matter of course now is that licensees are actually picking up the phone and talking to each other when advisors are transferring. And I think that will escalate those advisors outside of conventional models into setting up their own licenses. So I actually do think that will become an issue over time, which isn't a statement that everyone that's got their own license is not. That's not it, because that's basically what we did. We did that in 2008 because that was the only way we felt we could actually structure our business in such a way that we could do what we had to do for our clients. But I do think that is just a natural progression of what will happen over time. I think you're right, and I think the burst in self-license, particularly the smaller ones, I think that there needs to be some greater oversight. Then at the moment, there is no oversight. As I say, you're both, you're both the policeman and the villain, I guess, if to some degree when you're running your own license, so, or potentially at least. So it's a bit of a struggle. So another thing that's I've been watching over the last few years, and everyone in the industry has been watching, is obviously the war between industry funds and retail super funds. So is there a winner of that war?
I think of recent times, most definitely, and the winner has been the industry funds. Yeah, that's on your assumption if you do the measure purely in funds under advice. And they've kind of gone ahead quite quickly in the last couple of years. And I was just running off some numbers. So in March 2020, not forgetting the market dipped in March, the industry funds had 669 billion, retail funds had 556 billion. However, if you went back just to October 2018, which is not that long ago, they had pretty much the same at around 625 billion each. So it was around that time that the industry funds just moved ahead. The big issue for the retail funds is in what we refer to as the net contribution, and again, I've got all this on my website. The net contribution, if you like, is if you look at how much money is going in versus how much money is coming out, and then that's the net line, and that covers everything in terms of every single contribution and every single thing coming out. At the moment, the retail funds are running where about 5% of their assets over the last few quarters has been coming out. So the net loss is about 5% of their assets. Whereas if you look at the industry funds, they're instead of being a minus, they're in a plus 6% since about 2017. So they're growing quite rapidly just based on contribution before you get any market movement. So and that is a big concern. That's a major retail fund.
That's a very interesting dynamic and a change in just the way those funds need to be managed. They're fundamentally different, aren't they? One's in drawdown, one's getting new funds.
Well, one's in drawdown mode, and I think just generally struggling with that situation because you've got to manage your assets for the cash and all that to allocate for the money to come out. And then the other ones are growing. And secondly, the other ones are growing, and at the same time, they're also merging. We've seen a lot of mergers in the industry super funds. We've got a big one going on now between State Super and Victorian Super. There's been quite a number in Queensland and so on. So it's managing all those assets is becoming difficult. And then if you throw in the spanner in the works, COVID, where the values match. I was reading some figures. I think we've all probably seen them come out. $23.3 billion has been paid out into this early release scheme. About 511,000 people have put their hand up. Many of them are kind of double dipping. So went before June 30th and now going again in July to get their 10 grand. That's a big hit to how you manage your book, because that's come from left field. They wouldn't have been expecting that when before it was announced. So, and that's gone back into from the super funds and into the broader economy. And not quite sure what it's been spent on. There's all sorts of rumours that it's going into gambling, things going against the mortgage, buying new cars, all this type of stuff. I guess it's all a bit of that, but ultimately, I guess it's funds going into the economy in some way.
Yeah, sure.
That's been a big hit. We did see, again, I've got some of the charts there too. We did see that the super funds have predominantly been running on a lot less cash than the retail funds, and also holding a lot of assets which aren't necessarily listed. And I think one fund in particular has been copped a bit of criticism that it devalued its non-listed property assets. It's around March when people were taking all this money out, but now they've revalued them and put them back up, which I think is possibly a bit unfair. I'm not quite sure how you can revalue something going up in the
how that does not get the attention of a regulator is beyond me.
Yeah, it's been in the press a fair bit, so yeah.
That is, well, in my view, that is quite a serious matter. Speaking of which, self-managed super funds, Colin, how have they been going over the last few years? I mean, there was a point there that, to keep up with the Joneses, you had to have a self-managed super fund. Has that trend continued, or has it slowed, or?
It's definitely steadied, I think is probably the better word. It's very hard to get data on self-managed super funds. The ATO looks after that. So the stuff I was quoting you with regarding industry funds and retail funds is from APRA. The ATO gets the stuff, all the data from the SMSF. And I have written back and forth to them. Well, I haven't written to them. I haven't done anything back as to when the next lot of updates are coming. Although they do provide some of the data to APRA. And just to quote on the assets, I mentioned that industry funds are about 669 bill, and then ironically self-managed super funds were 675 bill, so it's very close to the industry funds. So it's a big sector, make no mistake about it. But it has dropped off. It was 704 this time last year, and it came down to 675. But everything kind of came off obviously in March when the market crashed. So they took a hiding there. I would expect in the next figures coming for June 30th they'll pop up again. And the number of entities, SMSF entities, was 586, and in 2019 it's grown to 596, up by about 10,000. It's not a huge jump, but it's still quite a big jump. It's steady, I guess you might say. So 10,000 over 596 is a relatively small percentage. What I thought that was interesting, and I'll share this with everybody, is that when you go through the APRA data, now all the major groups have to disclose how much money when the money goes out, what does it go out? Why does it go out? So, and part of that is how much of it goes to an SMSF. And then on the charts I've created is the net position. So X amount went out to SMSF, some came in from SMSFs, and then the difference is the net amount. And what we saw is for all funds, if you just punch in all major super funds, it was losing about 7 bill to SMSFs in 2017, but it's down to 2 bill, and there's a rolling year in March 20th, so that's the whole year. So it's less than a third is leakage, if you like, into self-managed super funds compared to what it was. If we take a close look at that and say, okay, what was the industry fund's contribution to that? In 2017, 2018, they were losing on a per annum, on a rolling quarterly basis, on a per annum basis was 2 bill to SMSFs. As of the March quarter, for the last 12 months through to March, it was 176 mil. So it's less than a tenth. So, that they've lost. So in other words, they've stopped that the floodgates, if you like. And industry funds are interesting funds. I did a lot of work on them in previous life. But the old 80-20 rule works pretty well for industry funds. You get 20% of their members basically represent a good 80% or more of the wealth. And so what they could see was these people with the big dollars were the ones who were losing the money to the SMSF funds. So they've actually, through the marketing and targeting and so on, they've been able to say, hey guys, come on, let's rather than you leave that money go to an SMSF, we can modify our super fund to make it convenient for you to stay, or more attractive to stay, as opposed to you taking that out. And of course, we had the Barefoot Investor and some big recommendations in that. And that shouldn't be underestimated. That book was the biggest selling book of the year.
It's still on the best-selling list.
And it's still on the best-selling list. And he's been pushing one particular fund, which is fine. And although I think he's come back a bit off.
It's the same fund you didn't mention earlier.
And also he's got a massive following on Facebook and social media and so on and so forth. So that may have had some influence, obviously, but the Royal Commission would have had some influence on that as well. Yeah. And even the retail funds, though, the retail funds have plugged the gap a little bit by about half. So the industry funds have plugged the gap down to about a tenth. So they've stopped 90%, whereas the retail funds have dropped roughly 50%. So
yeah, one of the reasons
significant.
Yeah, one of the reasons I think that maybe correlation doesn't equal causation, but the regulators, the ATO, ASIC, have been very, in my view, anti-self-managed super funds over the last few years. They've been putting out a lot of information. Well, we had the instance of the self-managed super fund fact sheet, which was, I won't make any comment on that. I think Tim Wilson said it best when he mentioned it in Parliament. So I think there's been, and self-managed super funds aren't for everyone, but I do think there has been a lot more negative news coming out, which would probably deter people from establishing self-managed super funds over the last couple of years. Whether that's right or wrong or whatever, that would just be my hunch. And I know in the advice world, advisors are very careful now about recommending self-managed super funds because of the stance taken by the regulator. So that might be having an impact as well.
Oh, I'm sure, and whenever all these changes start, it takes a while for them to work their way through the system, and by the time they get reported. So there is no doubt that all these things we're talking about, each one on their own, the effect might be relatively small, but when you combine them all, it becomes a big impact, I guess, on things like SMSF. And but maybe everything kind of reaches a peak of some sort, and then it starts to you said plod along. That's not the right word, but it tends to float around at a level. And maybe we've kind of reach that level of where it's appropriate for people to be in an SMSF. So as some of them drop off, new people will replace, and it may not be around the right number. But I still think there's opportunities out there for people to be in an SMSF and reap the rewards, I guess, of being in an environment which is far more flexible. We might talk about COVID in a minute, but certainly in how you might include the family in an SMSF more so than maybe as it is at the moment, where it's predominantly just I think about 1.5 people per SMSF. So there's either 2 or 1 in the SMSF.
Well, Colin, thank you very much for your insights, and I think the concept of having weathered the storm and then pushing forward, I think that's a great message to end today on, because financial advisors are out there and they're hurting. We've just got to get through this next little bit, wait for things to settle down, and those dynamics that you took us through, they will definitely swing the pendulum back into their favour. Once things settle. So we just got to grind it out a bit longer.
I think we've got to grind it out, and conscious of time, but just a couple of notes on the COVID, I think, where there's some opportunities there. I think at the moment it can be a bit dire, and because the impact right across the board, not just a health issue, but an economic issue and business issue. But certainly I think what we've all done, both advisors and anyone in work and all your clients have done, we've all done a crash course in video conferencing over the last few months.
Here we are.
And I think that shouldn't be lost on the advisors. And I think those advisors who are busting to get back to what it was would be a big mistake. I think the efficiencies that you gain out of using these type of formats I think are amazing, because you can get the client on board, you can get the client advisors. Very often the older clients will have their family members involved, and accountants and lawyers and so on, to get everyone around very quickly, and people now are far more used to that. That's a huge win, I think, over the longer term. A lot of efficiencies there, which I think would be great. Secondly, I think with the COVID's been described, I think, as a bit of a social experiment in many ways, through AIDS, a very worrying time, and B, the isolation and so on. But I think as through that, it's also been a time where I think people have been reassessing their work-life balance and what it is that they're trying to do. And certainly what I'm reading, what I'm picking up on, and I'm originally from the UK and seeing this happening over there a bit more, where people are beginning to say, well, do I really want to be part of this rat race? And because I can do things from home, I can do things from maybe a nicer community, and you're beginning to realise that if you do win the rat race, well, guess what? You're still a rat. So let's go out and do something different, and be a nicer person in many ways, and maybe in a different location. So we're seeing people maybe move away from their CBD type areas and look to do something differently, and also work from home, and they'll have that more balance in their life, which currently they didn't have, but now they've had to go through it and quite like it in many ways. And I think also too, people, particularly older people, have had an opportunity to reflect on their life a little bit more. And something I can see where I think advisor can add a lot of value is that there was a boom in wills apparently when the COVID thing started, or at least inquiries into will. And I think a lot of old people might be thinking, well, what on earth am I doing living in this very expensive house in Sydney or Melbourne or any other capital cities, whilst my children, not forgetting their adult children, are still struggling maybe with their mortgages, but at the current time, and maybe their grandchildren struggling to even buy a house, or whatever the case may be. Maybe let's downsize this house. Let's share the wealth bit now rather than wait till the inevitable, and then it all gets split up, doing it through a will. So I think there's some opportunities there, and I think an advisor, in advising these people who want a different lifestyle, who maybe want to bring forward their planning and how they might distribute their wealth, massive opportunity there for advisors. So yeah, it's not all bad news. I think there's some good news there somewhere.
Yeah, well, I think that's very good advice, and in particular, the one about the efficiencies, I think that's very important, and that's one of the things that's really hit home to me. You don't have to travel to somewhere, you don't have to find a park, you don't have to, the literally the 1 hour meetings are now 1 hour, they're not 5, right? So yeah. I think that is very sound advice. On the, as someone who's taken advantage of living in regional Australia, I don't necessarily want all you city guys coming and, raining in on my parade.
That's fair enough, yeah.
So you can just stay in the city if that's okay, because we've got a little hidden secret up here, so we want to keep it that way. But
no, I can see the background; it's looking beautiful out there.
Absolutely. So so I do think that hopefully we've reached the crux of peak pain as an industry. And hopefully things get better from here, and we can move forward. But we've just got to keep grinding it out and not lose the faith. I'm a big believer that, as long as people have financial issues such as saving enough for their retirement, being able to afford to live where they want to live, all those sorts of things, the need for financial advice is there, and it will be there going forward as well. All right, Colin. So how do people get in contact with you? What's the best way? Through your website?
Through my website. If they go hfs-consulting.com, if they do a search for that, they'll find me or Colin Williams. Feel free, you'll find some contact details on there. I'm more than happy to take calls on mobile, obviously video conferencing, email. There's a lot of stuff on there. But my main focus is to put some good stuff out on the website. But if you want the more detailed stuff, a bit more research, or if you want some support, doing a bit of internal benchmarking for some groups, things like that, happy to work with anyone who wants to get involved, basically. So feel free to give me a buzz.
Thank you, and thanks for joining us today, Colin. Great insights.